What's up, everyone? Hope you've all been well. I'm back with another update to my dividend portfolio. There's been two new positions plus some repeats. Had a bit of a hiccup, so that's why I hadn't posted for a few weeks and fell into a bit of a bad routine of not posting, but I'm back today. As always, don't listen to me. Don't take me too seriously. I'm basically just throwing money at a wall and seeing what sticks. So not long after the last one of these videos, I realized that I can't do math. It was tax installment season and I realized that I didn't budget enough. So I didn't add money. I did the account for a few weeks and yeah, so that's what happened first. Next, it was 2 weeks of repeat and I'm like, you don't need more of the same. Then I got into some new stuff and I kind of rebalanced the leverage situation a little bit, still within target. I just realized I was falling a bit below where I thought it should be. So quickly on the repeat, talked about it before, added a few more shares to Propel, got to 75 shares, which is enough for this account. Now, this account, I was really like, okay, I'm going to focus on dividends in this account, and that lasted like a few weeks before I'm like, ooh, shiny object. So yeah, I hit my allocation for this account. It's at about 2.5%, which is good. I mentioned in another video that I added some more to a growth account because it's more of a growth stock really. And I still think that, valuation's reasonable, a lot of growth potential, high returns on their retained earnings, and that's just really the formula for, what could turn into a solid stock over time. And I'll look at the valuations and the key metrics that I would look at for this one. Revenues growing 40%, pretty good, especially if that translates to the bottom line, which it has and more through operating leverage, positive operating leverage. Now, the one metric that I would say that makes this look not super cheap is price to book, because when I'm looking at financials, looking at this type of thing, price to book is a very big metric. Now, it doesn't tell the whole story because there's the divided by or multiplied by return on equity, which is, very relevant. But just if you're looking for the risk in the valuation and you're looking for, okay, let's say return on equity kind of trails down to a more, industry-wide level, the risk is in price to book. That's where it is. Because when you look at price to earnings for this type of thing, 18 times trailing is a bit high for the industry, but not necessarily for that growth. And you look at the run rate of the last quarter, which I'm not sure you should use because Q1 normally is a better quarter. But if you look at going forward, 11 times next 12 months earnings, it's not, it is very reasonable, especially if you think anything near the historical growth rate is going to continue. If you do, it's really cheap. Now, the new position, well, the first new position I should say, is Chemtrade Logistics. Now, Chemtrade is a bit of a diversified chemicals company. Now, for that reason, diversified and, chemicals, it's hard to say, okay, I think the price of XYZ is going to go to the moon and the stock is going to rocket up, or, it's hard to nail down a single thesis. But it's also not as volatile to the price of a single commodity because there's some that are pro-cyclical, some are counter-cyclical, and so it kind of mutes the volatility. Now, what I've gotten so far into the portfolio is 200 shares. Around this price, I could see myself adding more. I think the reason why I'm buying it and the reason why I think it is appealing is that I think when you add up all of the components of growth and shareholder return, it makes a lot of sense. You look at the yield, just over 6%. Now that's not dividend. It's not eligible dividend 100%. But still, let's just call it 6%, pre-tax, whatever. Then going forward, I think when you look at the capital deployment, when that starts materializing, you could see 5 to 10% growth. And also at the same time, I think you could see 5 to 10% buyback. Now, I'm not saying I think it yields, 26% or whatever that compounds to. I think it's more of a slider between, if it's 5% growth, it might be 10% buyback, or, on the lower end of one, the higher end of the other type of thing. But still, if I look at it, I think, even if I want to call it 5 and 5, it still looks like 6% yield, 5% growth, 5% buyback, 16%. And that's not bad on an IRR front. So that's why I kind of think it makes sense when you nothing super impressive, 5 or 6, 7% growth. It's like, meh, 5% buyback. It's like, okay, well, that works if the company's cheap. 6% yields, like, okay, that's not impressive, but you put it together and it makes for a compelling investment, in my opinion. Now, while this is not the trough valuation of almost any metric, it does, it is a significant discount versus where it was historically, especially if you look at a decade ago. You can see the valuations have, the EV to EBITDA has fallen. They've paid down some debt. They're on a price to book basis. They're more at historical ranges, but with probably a better balance sheet than a few years ago. Now, I think the valuation that historically would be looked at on something like this would be something along the lines of EV to EBITDA, but I don't know how much of that matters going forward, because the other thing that gets looked at on these things is payout ratio, or not the payout, but the dividend yield. And the dividend yield, like I said before, just above 6%. It doesn't look super impressive. It's not like, ooh, this is a 10% yield. I should buy it because, it's going to re-rate to a lower yield. So it's kind of reasonable. But as opposed to where it was in the past, the payout ratio has come down a lot. So the 6% yield is nowhere near maxing out the payout. It's kind of, I think it's on a go-forward basis, they said something like 45%. So, 12, 13% potential yield. So, which they're using to put towards better purposes than just giving it back to us. So, it kind of, doing the math a number of different ways kind of leads to similar potential. Now, the last thing that I've added since the most recent update is Alphabet. Sort of. Now, I'm sure most of you know Alphabet or Google, and so I don't really have to go into the details of business. Now, what I should say, much to my reluctance, is that this is not just the plain Alphabet. I'm not turning into one of those people, but this is the Google covered call ETF. Now, my reluctance to say that is because this is an area that is pretty conflicted, and I don't generally love the whole area for reasons that are outside of the scope of why I did buy this for Google. But in this particular case, I think it kind of makes sense. I think Google is the standout for big tech. I don't think search is going away. I think it's kind of going to be more kind of integrated into the whole AI thing. I think Google's balance sheet is pretty good. I think then the near term, with the cloud growth, with their being in AI, plus a bunch of other bets, I think that it is remains a bit more of a growth name than the market seems to be implying, and I think that the valuation is very reasonable. Now, the problem with me putting it through this covered call ETF thing is I don't really know how I could measure the IRR because I don't know necessarily the strikes of the options that are being sold. I think the leverage is a positive, but in this case, I think that the way I look at Google or Alphabet, the planned recycling of capital over time. So basically, in this type of account where I basically take the dividends and throw it back in a fresh idea, I think that, let's say Alphabet were to increase in value, at having the automatic selling mechanism of returning the capital to me so I could deploy it to something else. In this case, it makes sense. The times when everyone seems to just drip it, like reinvest it in the same thing, it's like, okay, well, that's just growth investing. I don't know. I don't know that that makes sense, but it's probably a rant for another time. But I do like, having the recycling of the capital so I can, over time not really have to, it becomes, basically the growth gets returned to me to set it into a fresh idea. Now, obviously for very mature companies, most people look at earnings and they should. I prefer EV to EBITDA for a lot of other things, and so that's why I kind of, for mental comparison wise, kind of like, okay, well, what is Google's EV to EBITDA? Alphabet, whatever. And it's kind of pretty reasonable, especially when you look at the continued revenue growth. Now, the revenue growth has decelerated over the years, but 13% revenue growth in, some of it's a capital light business, with a few businesses, like Waymo, probably heading near an inflection point with their scale. Cloud growing, a whole bunch of things. Cloud not being capital light, obviously. But, strong balance sheet. So I don't think that the downside risk is as violent as the company disappearing in a few years, especially because, if you really look at it, they're one of the leaders in AI that's supposed to replace search, but hasn't because search is still growing. So I kind of think, it can grind higher and, it still works. And as it works, giving me my capital back, okay, and de-risking the investment that I put in kind of makes sense. One thing I would say about the covered call in ETFs generally is that they're a great way to confuse brains with the bull market. And that's because they are complicated enough that a lot of people that I see talking about them, even people that have a lot of them and have a lot of income coming from them, I listen and I don't think they necessarily fully understand how it works. And when I look at how the covered call ETFs work, it's probably a topic for a longer video at some point. But the big thing is the cake is a lie. Hope some of you got that reference, but basically it's not a yield. It's not like, it's in no way the same as a dividend yield. It's not, a lot of them, it's not sustainable. It's giving you your own gains and capital back. And I'm very scared of the amount of people that are counting on these for income in retirement or to pay a mortgage. It's a recipe for bad things happening, and that is what I don't like about the ETFs. So now let's go for a quick summary. As of the time of making this slide, the net asset value for the account is roughly 116,800 Canadian dollars, or 83 US cents. The leverage, which I have increased kind of more than the organic bit recently, leverage now sits at 23.7%. Now my target for the stage that I'm at in life in this account is 20 to 25%. I do think that that will decrease over time, but for today, that's my target range, and I think that's reasonable based on what I'm trying to do here. The average monthly income for this account including return of capital, and that's not just from the covered call ETF. Some of the other stuff has some return of capital component too. Average monthly income, $432. Now that amounts to a levered yield of about 4.4%, which, I mean, considering the leverage isn't like super high yield, I think it's reasonable. I could see it going higher as I add more of the dividend stuff and less of the, kind of some of the stuff that was in there before. And this is the full list of what's in the Canadian side of the account, at least. This is all the shares, all the dividends. As you can see, still too much REITs. Need to move that down. But we're at 16 positions. Kind of want to get to many more than that, especially in this type of portfolio where there's diversification and lots of different things paying out. But I do want to add some more positions that pay like a relevant amount of monthly dividend, where the ones that really pay bigger amounts, I don't really have that many. But that's it for today. Thanks for watching. And until next time, good luck out there.